Okay, let's get started. Hello, everyone. Welcome to today's webinar. Today, we're going to be giving an update on the U.S. preferred securities market. And I'm very pleased to be joined today by Eric Chadwick, who is the president and head portfolio manager for Flaherty and Crumrine Incorporated. Brompton Funds has worked with Flaherty and Crumrine Incorporated since 2005 on various products, bringing U.S. preferred shares and Flaherty and Crumrine's experience to the Canadian market. Today we'll be focusing on a couple of our products, Brompton, Flaherty, and Crumrine Investment Grade Preferred ETF, ticker TSX BPRF, and also the enhanced version of that fund, Brompton, Flaherty, and Crumrine Enhanced Investment Grade Preferred ETF, which is ticker BEPR. It's February 2023. Just before we begin today, I'd just like to hit on a few of our disclaimers. Just want to remind everyone to please read this disclaimer. First of all, if you're watching this webinar, fees and expenses are associated with investment funds, so please be aware. Past performance of investment funds may not be repeated in the future. Today, Eric and I may mention some forward-looking statements. I want to just be clear that actual results may vary from those forward-looking statements. And for everyone that's interested in either of our funds, please read the prospectus before investing. And so with that, I've mentioned our two funds, and really the main difference between the two is that BPRF is a long-only investment in U.S. preferreds. BEPR is the same portfolio, but it has a leveraged exposure. BEPR holds approximately 30% leverage against the same portfolio of U.S. preferreds as BPRF gives exposure to. So that does give two ways to invest. There's two levels of distributions. BPRF has a 5.5% distribution currently, 8.7% for BEPR, so that is enhanced by leverage. For both funds, the portfolio is the same high-quality portfolio, minimum 75% investment grade. This is a medium duration product, and it gives good diversification to equity portfolios and to other fixed income. There's a less than perfect correlation, so there are diversification benefits to holding U.S. preferred shares for yourself or for your clients. Flaherty and Crumrine, I mentioned we've worked with for a very long time, since 2005. Eric has been with Flaherty and Crumrine investing in U.S. preferreds for over 25 years now. And Flaherty and Crumrine as a firm has over 35 years of outperformance in U.S. preferred shares and over $4 billion U.S. AUM, solely focused on U.S. preferreds. We are Brompton Funds. We've been in the Canadian retail market for over 20 years, providing income solutions for Canadian retail investors, and we have approximately 2.8 billion AUM. And we'd like to say, just as a demonstration of our commitment to income solutions, that we've paid out over $3 billion, so more than our current AUM, in cash distributions over the life of the firm. So just as a proof point to that statement. With that introduction, I'm just going to pass the floor over to Eric to give his update and outlook for our funds and for the U.S. preferred market. So with that, Eric, please.
Thank you, Chris, and thank you everyone for joining today. We're going to touch on the U.S. dollar preferred market and why we think it makes sense for Canadian investment as part of your diversified fixed income portfolio. So really, investors in fixed income really struggle with balancing three primary things, which is one, high income. How much income are you seeking? How much duration are you willing to take? And what kind of quality are you targeting? Investment grade, higher quality, high yield, lower quality, et cetera. We think that the U.S. preferred market today, and partly due to some of the transitions that have really taken place over the last 10 years, really position U.S. dollar preferred securities as the sweet spot within this triangle. So we'll talk about each piece of this as we go through. We'll have some slides to support each one. But really, the primary thesis is high quality U.S. dollar preferreds are heavily concentrated in financials, both banks and insurance companies. And as we'll talk about, the credit quality of the financial space is probably as good as it's been in the last decade. So very high quality portfolios. And we actually think of preferreds today as an up in quality trade, because you are moving up into that investment grade universe from an issuer rating standpoint. They do produce higher income, and that's primarily because of the subordination premium. So when you buy a preferred stock, you are taking a subordinated position in the capital structure. You're comfortable doing that, however, because of the quality issue that we just talked about, and we'll expand on both of those as we go through. And the other big change in the market really in the last decade plus has been duration. It used to be that if you wanted to own preferreds, you had to be willing to take a substantial amount of interest rate duration. It's a lot of exposure, particularly to the long end of the treasury curve. That has really changed pretty dramatically, and really it's changed because of the structure of the preferred securities that are being issued. Primarily, they are fixed to float or fixed to reset structures, which significantly reduces the duration, more than half of the duration that used to be, again, pre-financial crisis or more than a decade ago. So you no longer have to take a lot of interest rate exposure or hedge out that interest rate exposure in order to gain the other benefits that we talk about here in high income and high quality. So the three pieces together is we'll expand on each one and hopefully demonstrate that the changes that have taken place and why we think it fits in particularly into your investment grade portfolio on the fixed income side. So let's start with income. You can see here preferreds yield more than the components to the right, which compare both Canadian preferreds, U.S. corporate bonds, Canadian corporate bonds, et cetera, and of course treasuries. So there's always a spread to treasuries. I will tell you in today's market, we are probably actually outpacing the 5.9% shown here. This is an index-based comparison that we're doing here. But we've had some new issuance in the last few weeks that are into the low sixes and even low to mid sevens for some of the investment grade issuers coming to the preferred market. So we are definitely beating the average as we invest new money. But I think importantly, if you drill down a little bit further, the duration comparison and the quality comparison on this slide is really, again, just kind of supporting what we just talked about. Duration on the index here of 4.7 years. So just to put that in perspective, it's really positioned, the market is really now positioned very much like an intermediate bond fund. So traditional fixed income investment grade bond fund is going to give you probably something higher than 4.7 years. If you roll over a couple bars here, you'll see the U.S. corporate bond index that we're using in this slide actually has a duration of 7 years. You're actually potentially taking more duration and interest rate exposure by investing in U.S. corporate bonds than you are by investing in either Canadian preferreds or U.S. preferreds. And again, the quality, the next line down, the average credit quality of BBB minus, that is the investment grade range, and really, again, an important component of what we're going to talk about on the quality side. High yield bonds are yielding more than these categories, but I think it's a really important distinction to make that to invest in the high yield bond market, you should expect some credit related losses, right? Statistically, if you look historically, any way you look at it, you have to factor in some level of expected loss by investing in the high yield bond market. So that ultimate yield that you earn will definitely be less than what's the gross yield that you might see here. So again, it's kind of a different trade. We're looking at IG credit risk. We don't want to take a lot of credit risk. We'll take IG credits, but go down the capital structure to earn that extra income and gain the benefits of the preferred market. Let's talk on the credit side, because we believe this is probably one of the strongest supporting arguments for the preferred space. And again, it's been a transition. This slide looks at the aggregate common equity ratio of U.S. banks. And common equity is the purest form of equity. It sits at the bottom of the balance sheet, and it supports everything above it. So that includes preferreds, the senior debt, and of course, depositors, right? All the capital is really meant to support depositors. But as you can see here, this slide goes all the way back to the financial crisis in 2009. And you can see that since that period of time, the amount of common equity capital has not only grown, it's more than double what it was pre-financial crisis. And it has remained at these very high levels. So a lot of that has come from the regulatory side. U.S. banks are very highly regulated, as are banks really around the world. But coming out of the financial crisis, a lot of regulation really focused on the health of the financial system, systemic risk. And so they've introduced things like the stress test. They've introduced these capital requirements. They've restricted distributions to common shareholders of both dividends and share buybacks. So different forms of banks returning capital to shareholders, which has resulted in a much higher level of ongoing common equity capital. So if you think about where banks were going into the financial crisis versus where they are today going into the current environment, whether it ends up being a mild recession or we start to see slight increases in loan losses, et cetera, banks are positioned extremely well for that scenario, whatever it turns out to be. So the capital is really point number one. Point number two is earnings have increased and are very healthy. Very much a fee-based business anymore in the banking space. And those fee-based revenues have been much more stable and consistent over different cycles and also more diversified than they used to be. The other point is that U.S. banks, or banks in particular, are generally asset sensitive, which means higher interest rates mean margin expansion, which means higher net earnings. So banks in general are charging more for loans, but they're not paying a lot more on their deposits, which is really their funding base. And so that margin between the two is expanding and resulting in more consistent and higher net income. And it really can be pretty material as rates go up. And we've already seen it. As rates have moved up quite rapidly, of course, the asset sensitive banks have really benefited from that. Insurance companies, kind of similar, except in a little bit different model. As you all know, I'm sure insurance companies have really been struggling in a low interest rate environment. They've struggled not only on the asset side, but there's been great pressure on the liability side, which is really their policies, the promises, if you will, that they've made to policyholders, and a lot of pressure to pull the discount rate down as interest rates have come down. The result of that is it expands the liabilities of the insurance company. Therefore, they've got to change the asset coverage, et cetera. So higher interest rates do two things for insurance companies. One is it does mean higher earnings on their what is largely a fixed income portfolio, but also equities. So they're earning more on those portfolios, which they've really been struggling with. And probably more importantly, the discount rates of the liabilities can potentially move higher, which will, again, ease the pressure on the liability side. Lastly, I think it's important that back to the banking side for a moment, we saw many examples really coming out of COVID to begin with, but we've seen some ever since, is that banks are starting to get very aggressive in their provisioning. So when COVID rolled around, we saw U.S. banks in particular expand their loan loss reserves. So they reserve ahead of actual loan losses, and then as loan losses increase, they start to bleed those reserves back down. But an aggressive reserving is, as a preferred holder, is really what you want to see, because those reserves are shadow capital. So it adds to the line that you're seeing on this chart. So we want to see banks reserve aggressively and then use those reserves to pay down loan losses if in fact they do increase. All of that means that it all happens through earnings and the shadow capital and loan losses, and really does protect the preferred level of the capital structure and of course everything above it. So we want to see high capital, we want to see solid earnings, and we want to see aggressive provisioning when it comes to banks. Let's switch now quickly to duration. So this chart gives a number of different periods where the U.S. 10-year Treasury yield increases by more than 100 basis points. And as you can see, it goes back a long way, all the way back to the late 90s, early 2000s, 2005, 08, 10, lots of different periods here. And of course, 2022 in the far right chart. And I think what's really important here is that interest rates, preferreds haven't been as sensitive to interest rate changes as perhaps feared. And primarily the reason this exists is because preferreds have the excess spread and or higher income. And over time, if you stretch that time horizon out a little bit, income makes up for a lot of principal change. And a lot of times the principal change related to rate increases does tend to be shorter term in nature. And while you continue to earn that income, 2022 is obviously a rough year for anything with interest rate duration. And I think it's an important point to talk about here is that The preferred level, the preferred market has had a duration inside of 5 years, and our portfolio is currently inside of 4 years on the BPRF portfolio. But when you take the 10-year Treasury and move it up by an order of magnitude, 200, 300 basis points, it becomes a multiplier. And so even if you have duration of 3 years, you multiply it by 3, you've got it somewhere in the neighborhood of a 9% expected move. And that's really what you saw in 2022 was that although duration wasn't excessive in any of these products, except for the 10-year, of course, itself, the blue bar, the multiplier was quite large. So 2022 really was an interest rate event. It was not a credit event. Really very few credit stories to talk about in 2022. But of course, the 10-year Treasury and the entire yield curve moved quite dramatically. And at this point, of course, we're very inverted on the yield curve. So the short end of the curve has moved up even farther as the Fed has continued to increase rates and the expectation for the Fed. But if you compare these bars here, you'll see that kind of somewhat, perhaps surprisingly, one of the roughest investments in 2022 turned out to be the U.S. corporate bond portfolio. So what many people probably thought was their safest part of their portfolio turned out to be quite exposed because the level of interest rate and the magnitude of the move and the fact that the corporate bond space just simply has less spread, right? It trades inside of where preferreds would trade. And so you don't have nearly as much income cushion to absorb those changes in rates. So the preferred market actually did quite well, relatively speaking, in 2022. We, of course, saw negative returns because of the multiplier effect, but on a relative basis versus treasuries, corporates, or even the U.S. Ag, which also has a fair amount of treasury exposure, preferreds really look pretty good. So as we roll into 2023, we think one of the most important factors is not just the level of rates, because obviously rates have already moved. We've absorbed that move already. But what we've seen is, one, rates have come off the high. So the 10-year Treasury has kind of peaked out around 4.5%. It's down almost 100 basis points from that level. And it's even in the last week or so, it's moved up a touch, but it's still 80, 90 basis points below the peak. So the level of rates has come down. But again, what we think is probably more important is the stability of the Treasury market and the curve. So the trading range for the Treasury curve has also narrowed. And we use this ML Move Index as one indication. It's kind of similar to VIX, where it's measuring volatility. But as you can see here, we're starting to see the volatility of interest rates come down. And for the preferred market in particular, where you're looking to clip the coupons over a longer period of time, rate stability is perhaps more important to investors and sentiment, if you will. So getting investors come back into the market, think about the positive upside that's associated with fixed income, given the move that we've seen in 2022. And so we believe that even if rates stay where they are, even if the Fed holds the terminal rate a little higher than expected for longer, if rate stability improves, that's going to continue to be supportive for the preferred market and really fixed income, broadly speaking. And we've already seen that in 2023. We've had a pretty healthy January and a pretty decent February so far. And a lot of it, I think, is attributed to not only improved information coming on the inflation side, but the stability and how that's translated into the Treasury market stability. So moving past the 3 points on the triangle, let's talk just about the Canadian versus U.S. preferred securities market, because I think many might be surprised by the magnitude of the differences here. And again, we don't typically pit one versus another. We think of this as a real diversification strategy, or for those that have been involved in the Canadian preferred market for a long period of time, and they see the way that market is transitioning to a much smaller market with some issues around liquidity, et cetera. The US dollar preferred market is going to offer you an opportunity to stay in the preferred level of the capital structure, but gain some of the structural advantages that you'll see that come in the comparison here. So market size being the most obvious, obviously an order of magnitude larger, both in the market size and importantly, the number of issuers that you see. So gaining a very diversified portfolio from both a credit issuer standpoint and a structural standpoint in addition to a much improved liquidity in the space, is a pretty dramatic advantage over what has been, in many cases, kind of a struggle in the Canadian space. Very limited on how many issuers you can get involved with. A lot of the same issuers. The structures in the Canadian space have really been 5-year resets, and that's about all you get. In the US market, we're getting much more variation in the structures that are issued. The fixed to floating rate paper much of it is resetting off the short end of the curve, being 3-month LIBOR or what will soon roll over to SOFR, resetting quarterly. We, of course, have very similar structures in the 5-year reset paper, but we also have a fair amount of 10-year reset paper and even some in the middle. We saw a deal a week and a half ago that reset off the 7-year part of the curve. So it allows you a lot more variation as an active manager in the space to position the portfolio to gain all those advantages around credit quality, diversification, and of course, interest rate duration, right? So without having to reach on any of those things. Perhaps the other major important part of this slide really is in the bottom right corner, listing status, second row from the bottom. This is a really important distinction. Almost 70% of our market is institutionally oriented. And so I'll talk a little bit what that means. Let's start with the other side. 30% is exchange listed in the US. That's going to look predominantly like the Canadian market, right? Most of the Canadian market is exchange listed, $25 par values, a lot of fixed rate coupons or fixed to reset on the 5-year reset structures, et cetera. That's kind of the equivalent in the US market to the 30% that's exchange listed. The other 69% is institutionally structured, which means it looks like a bond. If you just compared them side by side or picked up a prospectus and looked at it, you may not even know it's a preferred stock without reading into the details. It's $1,000 par value. Most of them are fixed to float, fixed to reset type structures. The deal sizes tend to be $1 billion plus when they come IPO. And importantly, if you look at the investor base, it is by and large institutional investors. So that means asset managers like us who are buying them for fund-related products. Most corporate, U.S. bond funds or even equity income funds are investing in the preferred space, and they are mostly in the institutional side of the market. So what's the advantage of that? Well, one, it may sound a little bit counterintuitive, but the institutional side is not listed, but it's substantially more. It's not listed on an exchange, but it's substantially more liquid. So if you're trying to put money to work, you're trying to raise cash for some reason, perhaps you're doing relative value swaps, there's a lot more liquidity in the institutional side of the market that just really doesn't exist much in the Canadian side. The one exception to that is the newer structure, the LRCN structure that's being issued in Canada. However, for most preferred investors, particularly at the retail side, there are limitations, regulatory limitations around whether retail investors can buy into those, whether certain of the funds can buy into those. And it's really meant to be, LRCNs are kind of meant to be an institutional version of preferred exposure, preferred securities issued in the Canadian market. Those same issuers that are issuing LRCNs are also issuing either LRCNs or preferred structures in the US dollar market. And we consider the US side to be a global market. So it's US, it's Canadian, it's Australian, all the European banks and insurance companies are issuing into the US dollar market. So again, it's a broader, larger size market with a much broader investor base. And then the structural differences that we talk about here are really important. So we think that's something that the Canadian market really probably won't ever have, not least of which because just the size of the market will be limited by the number of issuers that are in that space. Whereas the US side of the market, US dollar side of the market is really continues to grow. Some of those structural differences and how they've worked out over time. Here's a 10-year performance of US preferred versus the S&P TSX preferred share index. And again, just a couple indices to point out some of what happened over a long period of time. And I think the bottom line to this chart really is that we could go through each one of these drops, some of which is the drop in interest rates and the exposure of the 5-year reset structure. The 5-year reset structure in and of itself is not a bad structure, but on the Canadian side, what we found was that the reset spreads were materially lower than the reset spreads that we were seeing in the U.S. preferred index or in the U.S. preferred market. And so that back end spread becomes really important when the benchmark rate, moves lower, as we saw the 5-year Treasury move both in Canada and the U.S. So the difference between the green line and the red line is, in our opinion, mostly structural, which means the advantage in diversification, the advantage in the breadth of the buyer base, and the advantage, of course, in just the back end spreads and the overall credit spreads in the space. So it's been a pretty consistent outperformance, and we believe those structural differences are perhaps even increasing given some of the shrinkage that we're seeing in the Canadian dollar preferred market. So again, there might be reasons to own both, but we think as you move forward and transition that Canadian dollar market moving forward, adding some of the U.S. markets or perhaps even transitioning to the U.S. market is going to give you all those structural advantages while still giving you the preferred level of capital structure. So another just kind of indication of the breadth and size and issuer diversification. On the left, the top Canadian issuers, on the right, top U.S. issuers. And most of these names on both sides will be very familiar to all investors. These are large, internationally focused corporations, mostly financial, as we talked about earlier. But as you can see on the right side, you've got U.S. banks, you've got European banks. Of course, as I mentioned, there are Canadian banks issuing into this space as well. And if you roll down to the bottom line on both charts, you can see an important statistic, I think, is the top 10 issuers on the left in the Canadian market make up 56% of the Canadian dollar market, whereas on the right, less than half of that, 26.8% in the top 10. So again, just really speaks to that diversification question, not only by issuer, but by structure, and of course, global issuers rather than concentrating that exposure in just Canadian organizations. So some of the things we've talked about so far leading up to this, really about the access to the institutional preferred market, the variation in structures, the credit quality that we talked about. The US dollar preferred market, or preferreds in general, really are one of the few markets that really benefit from active management anymore. Unlike so many equity markets where you can just simply buy an ETF that replicates the market and you get the exposure you're looking for, in the preferred market, you have to be really cautious when you're looking at indices or even ETFs, especially passive ETFs, because oftentimes they're only targeting a very narrow section of the preferred market. So you may not, in fact, be getting the exposure that you think you're getting or that you want. So active management has outperformed passive management consistently year after year. So some of the benefits of that, but again, we've talked about many of these, but access to the institutional side of the market is really important. In the US, the passive ETFs, the listed large passive ETFs cannot purchase anything unless it's exchange listed. So again, they're really targeting 30% of our market and ignoring the other 70%, whereas an active manager, of course, can take advantage of the entire market, which again is a structural difference that's going to be very beneficial over time. Premium trading securities, right? Every security, every preferred security generally is callable at some point in time. It's just a question of when and at what price. So you really have to manage both call protection and call risk, if you will, what we think of as call risk and extension risk. And so you can manage inside the portfolio the number of premium trading securities, how quickly the call dates are approaching, and really be able to better manage the reinvestment process that is inherent in all preferred investments. And we've really seen this distinction over time. The passive ETFs have had large portions of their portfolio callable. Much of that got reset at lower interest rates, a year ago as rates were so low for so long. And the result of that was, poorer performance coming into 2022. So being able to manage that inside the portfolio through active management is really important. Of course, as we talked about earlier, credit is really the foundation here. Being able to select high quality issuers and choose the most attractive securities from both a structural and credit standpoint. The reality is passive products purchase everything that fits into the index, regardless of credit quality. And so if you're moving down into a subordinated product like preferreds, that risk becomes amplified, right? So you want to be on top of the credit. You want to make credit your primary decision process and then add on the structural features as you build out a portfolio. So really important parts of managing the preferred space, unlike perhaps what you might get into, let's say, an S&P 500 investment. They are very different, and active management serves a very different role in our space. So quick focus here on our views. Again, most of what we've talked about here just kind of repeating, but importantly, we're getting the three pieces of that triangle, right? We're getting credit quality, foundation of the process. We're taking intermediate duration, and we're earning the income that we want. So we're adding call protection to the portfolio and maintaining that call protection so that you can manage the reinvestment process. We're also have been avoiding the low coupon fixed rate securities. So we've talked a lot about duration and what can hurt your portfolio. A number of the securities that were issued a year ago when interest rates were really low resulted in fixed rate coupons, let's say 4%, which means a very long interest rate duration. So again, the active management process in our view for a long time here has been avoid those low coupon fixed rate securities, buy the fixed to reset structures, target the duration as intermediate, and you're going to get a much better result, which in 2022 definitely proved to be true. Credit quality, as we talked about, banks are as well capitalized they have been in a decade, highly regulated, and also are asset sensitive, benefiting from those higher rates. The insurance companies have waited many, many years for higher interest rates to boost portfolio yield and reduce that liability exposure. So that is all coming into play here and is really credit enhancing for insurance space. And we haven't talked much about energy yet, but we do have some energy exposure in the portfolio. Many of the energy companies, which tend to be pipeline companies, are issuing US dollar-based preferreds. So that, but those balance sheets have also improved, really coming out of COVID. CapEx budgets have really been restricted. They've really kind of right-sized the cash flow and financing of those businesses so that they fit better into a slower growth, but continuing to grow, but slower growth and more stable commodity price environment. So we actually think the energy space is in pretty good shape as well. Just a couple more slides here. This is an ETF comparison. This is really touching on what we talked about earlier about active management, but a couple comparisons here, BPRF versus PFFD and CPD. And a couple things I would highlight: the green bars, of course, the yields that you're looking for, but again, you move down to the middle of the slide, that institutional access to that segment of the market is really crucial. The institutional side we talked about is more liquid. We are getting better structures, which means we're getting higher front-end coupons and better back-end resets, which again is going to be enhancing as you move into a year like 2022, or even hopefully a year like 23, where we're starting to see rates ease up a little bit. Those are going to perform better than the retail exchange-listed narrow segment of the market. High fixed to float reset. We actually have, as you can see here, about 11% of the portfolio currently floating, which is benefiting from the higher interest rates on the short end of the curve, right? 3-month LIBOR has moved up. We're in an inverted curve environment, so having some floating rate exposure is also benefiting the preferred portfolio from an income standpoint as well. So a lot of comparisons here that compare favorably to what we're doing in BPRF, again, largely driven by the active management process in our space. And lastly, a look at the portfolio itself. The yields that we talked about, duration 3.7, the average rating investment grade of BBB minus. Very diversified portfolio. 28% is our top 10, adds up to our top 10, nothing over a 4% portfolio position. And if you look on the left-hand side, the credit ratings, as we talked about, healthy into the investment grade part of the space. And the bottom side, and importantly, the exposure to financials. Banking, insurance make up over 70% of the portfolio. We believe that the high yield, the other non-financial segments of the credit markets are really where the credit exposure exists. So they did a lot of refinancing at low interest rates, but they also increased leverage. The financial area of the space, particularly banking and insurance, we're actually by and large deleveraging and have been deleveraging ever since the financial crisis. So we just think that the financial side of the market, which is really where preferreds are going to be concentrated because they're issued for regulatory capital purposes primarily, that really kind of is the sweet spot of where you want to be. And of course, we supplement it with the energy, other small sectors. I think importantly here is what you don't see, right? You don't see consumer cyclicals, you don't see technology. Those segments of the credit market don't issue preferreds because they're not regulated. They don't have any other reason to be issuing this layer of the capital structure. And we don't think that's likely to change anytime soon. So this financial focus, we believe, is the right place to be, but it's also going to be consistent with what we're going to see in the preferred market moving forward. So with that, I will turn it back to Chris and see if we have any questions.
Fantastic, Eric. Thank you so much for that very thorough overview. This slide is our Brompton sales team. There's me, Senior Vice President, Head of ETFs up top left. My partner, Manny Panvangsa, is Head of Sales, and he manages the sales team. If you are an investment advisor, please reach out to your sales coverage if you have more questions about BPRF, BEPR, or if you'd like to ask me or Eric any further questions. If you're a retail investor, the investor relations line is at the bottom of this slide. Please call in. We have some very knowledgeable people manning our phones, and we will connect you if necessary to whoever's needed to answer your questions. Eric, before I let you go today, just a couple of questions for you. One that I guess kind of came up when you're talking about managing call risk. Could you just tell me what is the problem with that? I mean, if I've got a bond and the issuer gives me my money back, I'm generally pretty happy. And I think you're saying that I shouldn't be as happy if the same thing happens with a preferred share. Just a little bit more color on that, if you would.
Yeah, sure. You're absolutely right. A lot of investors believe that a call means they get their money back, and that's a good thing. But generally speaking, not to get too deep in the weeds here, but the investor is actually short that call option. And we won't go into those details, but just know that the important part about being short an option is that if rates move lower, that's when the issuer is more likely to call that security away from you. And at the point at which they call it away from you, you have reinvestment risk. And so that's really the risk in any callable portfolio, is that you have a scenario where rates move materially lower, it all gets called away from you and reinvested at those lower rates, and then interest rates either stay where they are or move higher. In either of those cases, you're talking about lower portfolio level income because you're reinvesting at lower interest rates. And as we saw in 2022, particularly in the passive ETFs, you're talking about longer interest rate duration when you refinance at lower rates. So it's referred to as negative convexity. Again, we won't get into those weeds, but just know that a call is not necessarily a good thing from an investor's standpoint. The flip side of that is what we call extension risk, which is you don't get called. So you have to make sure that the rate that you're earning, particularly that back end spread that you're earning on a fixed or reset structure, is compensating you for continuing to own that credit if in fact it doesn't get called. So managing call risk, both our expectations and also laddering the portfolio so that you're not overly exposed to any one particular time frame, allows you to work your way through these interest rate cycles and manage the process of both reinvestment and extension risk at the same time.
Okay, excellent overview. Thank you very much, Eric. One question that we've been getting from advisors, or I guess a bit of pushback that we've been getting from advisors lately, just with short-term paper like GICs or short-term discount bonds, yield to maturities are approaching the 4.5% to 5% level currently. BPRF, for example, is an unleveraged U.S. pref strategy, yields 5.5%. What am I missing if I just park my money in a GIC and go from there? Give me your thoughts.
Yeah, sure. It's a great question. And this is a very common question anytime you get into an inverted yield curve. Why am I not just buying GICs, the short end of the curve, and earn, not the same yield by any means? So one is there is a yield advantage still owning BPRF over GICs. But importantly, it's about the upside. Those are really not even comparable investments. If you're investing in GICs, you're taking a very defensive position, you're hoping that you'll have an opportunity to reinvest that money somewhere down the road at higher rates or wider spreads, et cetera. So if you're investing in GICs, you're taking the reinvestment risk again, that the market moves and you're actually reinvesting at worse times than what you are today. So we believe that, again, coming out of 2022, there's definitely potential in the market, fixed income broadly, but especially preferreds, both from a stability in interest rates. The credit quality that we talked about is really fantastic. So kind of regardless of what kind of recession or slowdown we get into, the banking and financial system is in very good shape to handle that. So it's really all about being able to, if you're in a bond investment, let's say, if you're staying invested in credit and not taking this super defensive view with GICs, then preferreds are a very good substitution or alternative to that credit investment that you already have on the books. So again, they're not terribly comparative because we don't believe preferreds is an aggressive position, but you're trying to gain some of the upside and protect your long-term portfolio by earning the extra income now, but also having some of the upside associated with compressing credit spreads or the credit performance that we expect to see out of the preferred space.
Okay, so I might get the 4.5 to 5 for the next year, but then, let's check in. We need to check in again. Where are rates and what's happened to the U.S. pref market in the meantime, and how can I assure myself I'm going to get that kind of reinvestment of that?
Yeah, it's back to having to time the market. So all of a sudden you become the active manager. You're trying to time the market. You're trying to predict what the Fed's going to do, et cetera, versus taking a more intermediate position of let's gain the extra income now, right? Let's gain the extra 75 basis points today and every year after that, and not have to put ourselves in a position of perfectly timing the market. It's very unusual that folks that are in the GIC into the market time that perfectly, and so we think it's a reasonable risk to be taking to be in the credit markets, expose yourself to some of that upside that's associated with what will eventually be a turn in rates and a turn in credit spreads.
Okay. Just another question that's kind of related, Eric. What about corporate bonds? Like, why not just get a nice medium term or medium duration corporate bond portfolio? I've got a senior obligation. What are your thoughts there? Corporate bonds versus U.S. prefs?
Yeah, I mean, it's kind of a similar discussion as I just mentioned, which is you can gain most of the same structural features of a fixed income corporate investment without taking some of the risks that are associated with that, right? So as we saw in the earlier slide, the interest rate duration tends to be longer in the corporate market. So we think you can get higher yields by investing in preferreds, right? Because that's the subordination position. So preferreds yield more than corporate bonds, and you're taking less interest rate risk at the same time. And as we mentioned earlier, the exposure to the financial sector of the market that is the preferred space is different than what the broad corporate market, where you're going to have a lot more exposure to some of those non-financial industries. So we think there's just more risk associated with that position. In the preferred space, you're taking subordination risk. So it's important that you have really good credit performance. But with the credit backdrop that we've discussed, we think that's likely to be the case. Importantly, I think, as we saw in 2022, the negative impacts of interest rates, we believe that for corporates to really outperform moving forward, you need the opposite. You need rates to move lower again. And I think as we're here today with a very inverted yield curve, it looks like we've got a fair amount of time before we see any pivot out of the Fed, potentially into Q1 2024. It's going to be difficult for the corporate market to really move a lot unless interest rates move lower. So they don't have as much spread as preferreds. And so it's really that spread advantage that you're looking for, because the other components are very similar, both from buying IG issuers, intermediate duration, but you're getting paid that extra yield while you, in effect, wait for all of this Fed cycle to play out. And then you also have some upside on the preferred space if rates do move down. So it's just a bit of a different risk reward profile. But we think in a very good credit position, going down the capital structure and earning the extra yield, is really a better trade at this point, or at least a substitute for some of that investment grade portfolio that you're doing.
Okay, fantastic. Final question for you today, Eric. Is there any risk to your outlook? Like, what happens if things don't turn out exactly as we're planning right now?
Yeah, I think as we look forward, much like 2022, as I mentioned earlier, 2022 was not a credit event. It was very much an interest rate event. And so I think interest rates, although we are intermediate duration, we've had a huge movement in interest rates. The Fed is definitely nearing the terminal rate, although it may not be there yet. We don't know exactly where it is. But the market has definitely priced in some of that turn that they're expecting. We've seen inflation numbers start to come down, but they are still higher than they need to be, and definitely higher than the Fed's target of 2%. So rates, I think, continue to be that outlier, which is going to be driven by the data. So the Fed has said over and over again that their position and their future moves are going to be data dependent. We absolutely believe that. And so we need to see the inflation data continue to move down, even if slowly. I think direction is more important than speed or pace. But we need to see the market continue to get news that's supportive of the position that, in effect, the intermediate and long-term part of the treasury market is telling you, which is that inflation expectations over the long run are well anchored. That's why the 10-year and the 30-year are yielding well below what the short end of the curve is. So that's a more traditional scenario where you expect the Fed to raise rates and then eventually start cutting rates, and you'll end up back with a positively sloped curve eventually. So the risk, really, in our opinion, is on that data side, right? We need to see the data come in favorably. We need to see the Fed reach a point and perhaps pause and see how things go. And importantly, as we talked about earlier, the stability of rates is going to be a really important factor. So to the extent we end up with higher inflation prints, a higher, more aggressive Fed policy, and therefore higher volatility in rates, some of the factors in 2022 could exist in 23 as well. But the market has already priced in some of that good news. We need to continue to see the data move in the right direction.
Okay, thank you very much for that update and overview. Definitely food for thought. Thank you, everyone, for joining us today. I hope that Eric has made it clear to you just how different and how attractive the U.S. preferred share market is compared to the Canadian market, and the place that it has in your investment portfolio. And again, I invite you to reach out to your sales coverage if you'd like more information, if you're an investment advisor, or please do call our investor relations line. They will take good care of you when you dial in. Thank you, Eric, and thanks one more time, everyone. Have a great day.